What's amazing is that, so we talk about the water levels of the Rhine. Everyone's suddenly an expert on that, on an hourly basis, and it really illustrates how tight these global gas markets are.
Yeah, energy crisis is facing Europe in particular, but actually the global economy as we head into winter, and we're looking at the very surreal prospect of energy rationing facing Europe, right? And this is why we have the expectation that we're going to head into a recession in Europe this side of this year, and then potentially growth stalling next year in the US.
Am I wrong in thinking this is not priced in the markets?
In terms of equities, no. In terms of equities,
Why
no.
Not?
I think there's a lot of technical factors supporting this bear market rally, right? You talked about short covering, and you also talk about some of the hopes for soft landing rather than expectation for soft landing. So equities not pricing that appropriately, but we believe credit is pricing in a mild version of growth slowing down, which is why as we think about portfolio construction, we prefer an up in quality adjustment to portfolios. We prefer credit over equities because the different degree to which they are pricing in the growth slowdown.
So do you make a difference between European equities to US equities? And in all of this, I mean, do you need to go to emerging markets actually to find value?
Well, currently we have a -1 allocation to European and US equities on a scale of -3 to +3, so modestly underweight because we're waiting for that dovish pivot on a sustained basis. That is not coming through, and also earnings are way too positive. We're broadly preferring credit over equities, and even including in emerging market as well, we prefer emerging market debt over emerging market equities.